All right, so stimulus is back, rate cuts are back, and it's time to finally start discussing what this is going to look like for the overall wealth gap, what it's going to look like for your personal finances, your business finances, where's the money going to be, where's the opportunity going to be, and where are the casualties going to be. There will be winners and losers in this scenario. So we're going to be covering a lot of information in this live stream. The goal is always is to keep you up to date with what's going on with the financial system and bridge it back to your personal finances, trying to do my best to make it as plain English as possible and give proper levels of urgency as possible, because the information that I'm providing you is what's going to help you minimize being a victim to these circumstances and changes, and hopefully find opportunity in these circumstances and changes. So everybody coming in live, make sure that you leave your likes, leave your support, let me know in the chat that you're in the building. If you have any questions specifically, make sure you leave a super chat. I'll be sure to get to that. And other than that, anybody catching the replay, I appreciate you as well. Make sure you leave a comment, leave a like. I'm very responsive in the comment section. If you have any questions, feel free to leave a super chat as well. I'll be glad to get to it. But other than that, we're going to get into the weeds of this. So we're going to be covering what the Federal Reserve is. So I'm not going to assume everybody that catches this knows what the Federal Reserve is and who they are, what they do. So we're going to get into who the Federal Reserve is, what they do. We're going to get into why stimulus is back. What is economic stimulus or rate cuts? The economic and financial cycle we're going into as a country, rather. What does that look like? What is it? We're going to get into that. The benefits, the pros, the cons. Then we're going to get into, the drawbacks or the concerns of these rate cuts and this economic cycle we're headed into. And we're going to look for the opportunities towards the end. We're going to get into solutions, as we always strive to do, and get into opportunities and potential, positives or areas of potential gain or opportunity with this new economic cycle that we're in. So for those of you who may not know, really quickly, the Federal Reserve is the central bank of the United States. It was created in 1913, and what they do is pretty straightforward. They are over our monetary policy in this country. The Fed uses its tools to influence credit and money conditions in the U.S. economy, aiming for full employment and stable prices. So what that basically means is they try to do their best to keep the economy growing at a healthy rate. They try to keep the price of goods and services from fluctuating in a negative direction too much. And they do their best to keep the economy healthy when it comes to employment. So keeping the average worker employed through their monetary policy controls. Bank supervision, it oversees and regulates banks to ensure that they operate safely and soundly, protecting consumers and credit rights. Hopefully that makes sense. Shout out to everybody coming into the live stream. Leave your likes. Let me know in the chat that you're in the building. Other than that, if you have any specific questions around what we're going over, leave a super chat and I'll be sure to get to it for you. Financial stability. The Fed works to prevent financial crisis and contain systemic risks that could arise in financial markets. That is an important one we're going to be talking about in this live stream. So by any means, doing good, man. How you doing? So financial stability is a big one we're going to cover. That's going to really give the motivation behind the Federal Reserve's rate cuts as it stands right now. So we're going to come back to that one shortly. Financial services is something else the Federal Reserve does. It provides essential services to the U.S. government, financial institutions, foreign officials, and including operating the nation's payment systems. So the money that's going in and out of, international payment systems, when you think about, money that's getting, sometimes wired off, going through the SWIFT system, things like that, that is going to be the Federal Reserve in the Federal Reserve's warehouse. Community development. The Fed collaborates with communities to promote equal access to credit and advance economic development. So again, another important component to the financial function in this country, the Federal Reserve's job. If y'all got any questions, leave a super chat. I'll be sure to get to it for y'all. Let me know if y'all got any questions. Appreciate y'all likes, y'all chats. Let me know y'all in the building. So components of the Federal Reserve, there's a board of governors, there's 12 regional banks. So you may hear about the Fed of New York, the Fed of Atlanta, the Fed of St. Louis. There's different regions the Federal Reserve is broken up into. And then there's the FOMC, the Federal Open Market Committee. They make key decisions on monetary policy. That's who's going to be the ones that come up on a podium and talk about we're cutting rates, we're increasing rates, we're keeping rates the same. This is the economic conditions that we're in, etc. Shout out to everybody coming in the building. Let me know y'all in. I appreciate y'all. Make sure y'all leave y'all likes. Make sure y'all leave y'all likes. Leave me some chats. Let me know you're in the building. Any specific questions you have around the topic being covered, make sure you leave a super chat and I'll take care of that for y'all. I'll get to it. So what is economic stimulus? And why am I focusing on calling it economic stimulus instead of just talking about rate cuts? So let's get into the weeds on that. Economic stimulus is a coordinated effort using fiscal policy, the government spending, fiscal is government, monetary policy, central bank, that's the Federal Reserve, to encourage spending and investing, boosting aggregate demand and economic growth. Hold on to that. The goal is to counteract recessions by increasing job creation, consumer spending, business activity, and often through measures like direct payments, tax cuts, and easier to access credit. Thank y'all for leaving y'all likes. I see y'all running it up in there, leaving y'all likes. Any comments, any questions, make sure y'all leave a super chat that is relevant to the topic, and I'll take care of that for y'all. So very, very important. I'm gonna read that part again. Often through measures like direct payments, so direct stimulus that we received during COVID would be an example of that. Tax cuts, the one big beautiful bill, for those of you who've been paying attention, that has come into play. Even though it doesn't seem related, I'm painting a picture for y'all. And easy access to credit. For those of you who are looking to access funding on the personal or the business side, your business owners, entrepreneurs, this is relevant for you as well, because part of economic stimulus is trying to get more credit into the system. So fiscal policy is the government spending, tax cuts. Government spending is going through the roof right now, which is a part of our economy, because the more they spend money, that's a part of the job creation, and it's the government jobs and other government contracts and that money pouring into the system. Tax cuts, the one big beautiful bill, made a lot of tax cuts from the previous Trump administration permanent. It also puts stuff like the bonus depreciation on real estate investing and things of that nature. Other job creation related tax cuts and things of that nature in. So we did experience the portion of economic stimulus that is fiscal, the government. May not have looked related, but it is very related. Make sure y'all leave super chats if y'all got questions. Let me know y'all in the building. Monetary policy. So we already got the fiscal, the government part. They did their part in stimulating the economy, or starting the process of stimulating the economy. Ironically, even though they look like they're having it out with each other, Trump and Jerome Powell and the Federal Reserve and the government, you see that there's some unison here. The tax cuts are in, the government spending is up. So the next thing is going to be the monetary policy. So that's going to be rate cuts. That's going to be lowering interest rates, make it cheaper for businesses and individuals to borrow money, encouraging spending and investing. Encouraging spending and investing. That is the biggest motive of stimulating the economy when it comes to rate cuts. So we're talking about making credit cheaper. We're talking about putting more money in the system. We're talking about an environment that creates more jobs, or an environment that tends to lead to wage inflation, meaning your income increases as an employee as a consequence of more money being in the system. This tends to be the case. And more investing. So the more money that's in your hands, you're going to spend a lot more money as a consumer and as a business, and you're more likely to invest, right? You're more likely to invest. So that's some key components to what the Federal Reserve is doing by lowering rates. Quantitative easing. You may have heard of this one, QE, quantitative easing. This is increasing the money supply and credit availability. This is huge for all of us, but especially if you're an entrepreneur or a business owner, you're trying to access capital for some reason or another for, investing, starting a business, whatever the case may be. This is where that comes into play, because prior, the cycle that we're coming out of was quantitative tightening. It was when the Federal Reserve was trying to restrict credit, lower the money supply, or slow down the increase in the money supply, increase rates. Okay. So at the end of the day, now we're in a scenario where they're trying to shift course. Rates have been down for quite a long time. And now what's happening, one of the earlier things that I mentioned to you, price stability, the job market, these are two major mandates for the Federal Reserve. You're starting to notice now that they're saying, okay, the unemployment thing is looking less healthy. And there's something important to keep in mind. These moves, these rate cuts and stuff that I'm talking about and teaching you, these have a lagging effect. So what that basically means is when rates go up or down, it isn't an immediate effect on the economy. It's months of these things happening, and for these things to take place and actually flow into the economy, it takes a while for that credit to flow in, money to flow in, or for it to subside and stop. for prices to stop going up if they increase rates, right? So it is very important to understand if they're looking at shaky data right now, influencing them to cut, that means that what they're doing now could take months to kick in to stop what they're concerned about. So if that's prices going up and they make rates go higher to push prices down, they know if inflation is right here, right now, us making changes in a policy and making money more expensive and credit more expensive, rather, is going to take some time. So that means inflation is probably going to go up for a longer period of time before what we're doing kicks in. I hope that makes sense. The same thing with them cutting rates. Right now, the job market is showing instability, and they don't like that. They don't want that, because what that means is part of their mandate is becoming more important than the other. We kind of got prices stable, even though they never reached their 2% goal, mind you. But we kind of got prices stable. But now unemployment is starting to look a little shaky, and we know we need to get ahead of it and before it gets bad. That is basically what's going on. So the Federal Reserve is doing their part in the stimulus by cutting rates and starting a quantitative easing process, which will definitely lead to job stability or job creation, or economic investment by businesses to hire more people, which again will take time. Okay, purpose of economic stimulus: combating recessions, which is something they're going to be concerned about. When you have job loss and you have unemployment picking up, you could be risking a recession. Increase aggregate demand to boost overall demand for goods and services. Another part, again, this leads right back to the job part. Businesses will either hire or fire people based on the demand for their goods and services, right? That makes sense. So at the end of the day, what they're doing is pumping more credit and money in the system, putting more in the hands of consumers indirectly, finding other indirect ways. COVID was a rare scenario where they literally put the money in our hands, right? But in this case, it's going to be indirect. We're going to talk about where that money is going to go later on in the live stream, some of the places that money is going to go. And then supporting recovery to make the economy recover from a more robust and reduce the depth and the duration of the recession. So if we are in a roll, and it's what many are calling a recession, or we're heading for one, the goal is to reduce that. It's like taking medication. As soon as you see symptoms of a cold kicking in. Does that make sense? Make sure y'all continue to leave y'all likes. Make sure you leave y'all likes and let me know y'all in the building in the chat. All right. So, damn, Fred, a professional hater. That's funny. So at the end of the day, hopefully this is making sense so far. You got an idea who the Federal Reserve is, and then you got an idea of what they do and why they're doing what they're doing now. The Federal Reserve just cut rates this Wednesday that just passed of this live stream on the 17th. And they're expecting to cut rates potentially for the rest of the year and going into 2026. That means we're in a rate cutting cycle. We're in a rate cutting cycle, meaning that they're not just cutting rates that 1 or 2 times and kind of, nudging things along and then gonna freeze back up. They're like, nah, we on our way cutting things down, because what we're seeing is signs that we need to ease policy. We need to put more credit in the system, more money in the system, and make money and credit more affordable. We need to increase spending, increase demand, and increase investment. President Trump and his administration already did the tax cut part. The government spending part is already in the horizon. It's already baked in. That's happening like crazy. Now the Federal Reserve is kicking in and saying, okay, this data is coming in, and at least that's their excuse for it. The data is kicking in. It looks like it's time to start cutting. All of this is happening in unison. The one big beautiful bill passed in July, I believe. The Fed is starting to cut rates in September. Gonna be an interesting 2026. Gonna be an interesting 2026. So what are the benefits, generally speaking, of rate cuts? And I want y'all to let me know what y'all think in the chat down below. But I'm gonna read off some things to you, and I want you to let me know some specific scenarios that you think the benefits of rate cuts may be while I read off. So by the Federal Reserve, the benefit of the Federal Reserve cutting rates for the economy is lowering borrowing costs for consumers. That is a big one. Big one. That is very important. Lowering borrowing costs for consumers. So for those of you who are thinking about car loans, credit card interest rates, indirectly, but to some extent, mortgage rates, even though there's some differences there, but there's some correlation there. Capital, access to capital for lines of credit, businesses, right? So consumers and businesses, which encourages spending, investment, and job creation, thereby stimulating economic growth. The lower rates make mortgages, auto loans, and credit cards that cheaper to manage and create opportunities for refinancing existing loans to reduce costs. A downside for some is savings accounts yields also tend to decrease, providing less income for savers. We will talk about that as well, but I will say it right now, savers will be losers in this economic scenario, and they usually are in most economic cycles. But we did just come through a time frame where savings and CD rates were the highest they've been in like 20 plus years because they're very closely correlated to the federal funds rate. So banks are going to pay when the Fed funds rate goes in one direction or the other, that affects banks' profit margins. So if mortgage rates come down, credit card rates come down, etc., then that means banks are going to pay less on savings, CDs, because that's their spread. That's a huge part of their spread. So if mortgage rates go up, credit card rates go up, they can afford to let savings and other deposit account rates go up because at the end of the day, the spread is higher. Hopefully that makes sense. They're still making money. Benefits to consumers: lower borrowing costs, refinancing opportunities, stimulates home buying. A huge area where this is going to take place. So keep up with that. Benefits for business: cheaper business loans, very important. Those of you who are in that space. Increased investment: lower borrowing costs encourages businesses to spend on capital investment and other initiatives. Make sure y'all leave your likes. Continue to leave your likes. Any important or pressing questions or specific questions, leave a super chat, and I'll make sure to get to that for y'all. Job creation: if you're a business, lower rates mean job creation. Increased investment in economic activity often leads to businesses hiring more people and creating new jobs. Very important. Broader economic benefits is overall economic growth and increased market confidence. The stock market, that's another area we're going to try to talk about in this live stream. There's so much to cover, but those of you who have 401ks or investing in some kind of retirement account or individual retirement accounts, IRAs, or in the stock market directly yourself, this is going to be a huge nudge in a positive direction for you if you're in the stock market, generally speaking. Not every single sector is going to benefit, but the general stock market will appreciate and react kindly to lower rates because of the economic growth, because the stock market is made up of what? Businesses. It's made up of businesses. So at the end of the day, when those businesses have lower borrowing costs, when they have the capital they need to invest and grow, when they have more demand for their goods and services, they tend to have better earnings. They tend to do better as a company. So that pushes up the value of the company. Do you understand that? Does that make sense? Chat down below if that's making sense to you so far. So being in the stock market is one of those great places to be, generally speaking, when rates get cut. I appreciate y'all getting busy in the chat, even though some of y'all leaving some funny comments down there. So we looked at the icing on the cake. What's some of the drawbacks and the negatives of Fed rate cuts, right? The primary drawbacks of the Fed cutting interest rates includes the risk of fueling inflation, which hasn't quite been tamed yet as of 2025, right? It's been down quite a bit, but it hasn't fully been tamed yet. So that's important. Potentially causing prices to rise quickly, lowering returns on savings accounts and CDs for savers. That's another big one as well, because a lot of people like to sit on the sidelines on savings and CDs. Potentially increasing market volatility and investor risk. Another big one. I just talked about how lower rates is favorable for the stock market. It can make people be greedy. Lower rates can also make borrowing more expensive, more attractive, which may increase competition on home prices. And if the economy doesn't grow as expected, it could contribute to worse of both worlds, called stagflation. So for those of you who haven't heard of that crazy economic term, think of it this way. Inflation is an overactive, overheated economy with too much activity, too much money chasing goods and services, right? That's one way to look at inflation, at least. Stagflation is going to be a stagnant economy, meaning the economy is still not growing, even though there's more money in the system and rates are down, but things are still costing more at the same time. That's an utter disaster. That is literally the worst economic cycle you can experience, generally speaking, in a country. Deflation is really bad. Inflation is really bad. The stagflation is the worst because it's the hardest to treat. You basically have a scenario where the economy is not growing, even though you're stimulating it, but then you have prices still going up. Things are still getting more expensive. It's not a good combination at all. So inflationary pressures, prices of goods and services may increase if rates get cut. Risk of stagflation, what I just broke down, where you have a stagnant economy, but things are still costing more. Impact on savers. This is a big one. A lot of people like sitting in cash. The impact on savers, lower returns on deposits. When the Fed cuts its benchmark rate, the interest rates on high yield savings account, money market funds, and certificates of deposit generally decline. That is a fact. Market and investment risk, increased market volatility. While lower rates can encourage investments in stocks, the reason for the rate cuts, such as economic slowdown, can also lead to increased stock market volatility. So too much activity, too much going on. Higher risk investments. Again, investors may seek riskier alternatives like corporate bonds or equities to achieve desired returns when traditional lower yield investments become less attractive. So when it becomes less attractive to be safe, you may take on more risk as an investor. You're not getting the returns you once were because rates are down. So now you have to chase more aggressive investments, can lead to more risk. Housing market and borrowing. Higher demand and potentially housing prices, higher demand and potentially rising home prices. Lower mortgage rates can entice more buyers to the market, increasing competition and potentially driving up values. That is highly likely. We saw it during COVID. Shout out to y'all leaving y'all emojis and y'all comments, y'all chats, and y'all likes. Good job, good work. Any questions, leave a super chat. Increased credit card debt. Lower rates can make the borrowing more attractive, and without a strong financial cushion, consumers may take on higher interest debt according to bank rate. So this is important. People will be riskier with investments and they'll be riskier with debt when both are more available, right? When there's a higher demand. So for those of you who may be in the Black and brown community particularly, this is for you for a second. What are the risks when it comes to the Federal Reserve cutting rates? For those of you who are in the Black and brown community in particular, because the reality of it is, economically speaking, you are getting the impacts of things harder than any other group in this country. Federal Reserve's interest rate cuts carry complex risks to the Black community, primarily due to existing structural inequities in wealth and finance. While rate cuts can stimulate the broader economy and create jobs, their benefits are not distributed equally. They can exacerbate disparities in housing and wealth. This is a big problem. Yep. What's it? Tom Scott, you're right on the money. That is correct. That is one of the consequences of lower rates. You are spot on, good sir. Now is it time to put money into the stock market? That is correct. Tom Scott, you are right on the money. Shout out to you in the chat. Shout out to you. You are right on the money. Lower rates, this is a great time, generally speaking, to be in the stock market. We're going to get into the other places where it's good places to put money. But Tom, that's some great comments. Good work. Risk related to housing and wealth, exacerbating the racial wealth gap. You see it in the title. So I'm putting it out there right now. The Federal Reserve lowering rates will take those who have means already, give them access to more means at cheaper rates and better terms, better opportunity to invest. Their companies are going to do better, and they're going to get access to assets way faster and at better circumstances than the rest of us. So this is one area where this can be a problem. Because of systemic barriers, many Black families already possess less wealth and are less likely to own homes. Rate cuts can worsen this disparity by making investment assets owned primarily by wealthier, typically other groups of people. Households grow in value more rapidly. Research has shown that lower rate environments disproportionately benefit the wealthy, widening the wealth gap without significantly improving the financial position of less affluent people. Very important. If you're on the wrong side of the wealth gap already, then rates getting cut can hit you over the head and knock you down while you're already struggling to get back up. Persistent mortgage lending disparities. Black and brown home buyers and homeowners often face higher interest rates and more restricted lending terms than their counterparts, a pattern of discrimination documented by Harvard and others. When the Fed cuts rates, many counterpart borrowers may be able to refinance to a lower rate, but Black borrowers may still be denied or receive less favorable terms, limiting their ability to build wealth through home equity. Housing affordability paradox. Lower interest rates can increase competition for housing, driving up home prices. So while the mortgage is cheaper because the rate is down, the price is going up because more people can afford it. This can offset the benefit of lower monthly mortgage payments for new buyers. But many Black buyers already face barriers like lower average incomes and less inherited wealth. Raising home prices may make homeownership even more difficult to attain. Reduced income for savers. Retirees and others with large savings, including some in the Black community, may see a decline in interest income from savings and other fixed investment incomes, or fixed income investments. So again, if you're in a Black and brown community, you tend to keep more in cash because many of us either are scared or don't understand investing. And you may also just be at a chapter in your life where it's important to just save and stabilize your investments. It's not time to be in equities and growth related investment strategies. So you're in cash like assets. Lower rates, lower returns impacts your wealth. Risks related to employment, slower benefits in the job market, inflation impacting low income families. So rate cuts can be disproportionately negative for Black Americans, for brown Americans. Very important to understand that. And this is why hopefully most of you who are watching this live stream, or a good portion of you that fit the description, are paying close attention and understanding how this works, why it's happening, and how to position yourself, which is where we're about to get into next. So the economic opportunities are in different sectors for rate cuts. So I want y'all to pay close attention. If Trump gets his way, the working class will get more work and higher wages due to workers to create the high supply in order to reduce the price of. Yes, Tom, that is generally how that can turn out. Generally, if Trump gets his way, the working class will get more work at higher wages due to competition for workers to create the higher supply in order to reduce the price of each of them. Yes, that is generally an outcome that can come from this. It's very important. The original thing you said, if he gets his way, that could be a potential outcome. The tax bill that passed that's supposed to do its part in stimulating the economy through the fiscal end of things. You have rate cuts, you have more credit flowing in the system, you have lower rates making it more affordable, et cetera. Looser lending terms, or at least slightly more lenient lending terms, ideally, leading to businesses doing better and higher demand for their goods and services, on and on. This can lead to a better environment for the working class, generally speaking. That is fair. So sectors where lower rates can be beneficial. Let's start paying attention to where the opportunities are for these rate cuts. Very important. So real estate is one major broad sector. When the Fed lowers rates, it can lead to increased activity in the housing market, benefiting both investors and home buyers. Very important. You able to hear me now? I appreciate you letting me know, Ben. Hopefully it hasn't been out for too long. All right, thank you, Ben. I appreciate you. Thank you. Has it been out for long? Can you tell? Anyway, so the real estate market picking up is huge because it creates a huge impact on jobs related. A lot. Back on? I'm back on. Y'all excuse me having some quick technical issues. Can y'all hear me the regular way? Microphone is off, but can you hear me the regular way? Y'all let me know. Can y'all hear me now? Y'all can hear? Is it okay? Is it reasonable? It's not microphone, but is it reasonable? Hearing me this way, is it reasonable? All right, cool. I appreciate it, y'all. Thank y'all for letting me know and not ramble too much without this thing off. All right, we're gonna get back into it. I think we had a battery die on this, so it's all good. We're gonna keep it pushing so we can get to this information, y'all. So the next area other than real estate that's going to be benefiting dramatically is going to be the stock market. We already covered that. We talked about that, right? But we're going to get into the weeds of the specific sectors that can benefit from the Fed rate cuts. So lower interest rates can be a tailwind for the stock market, especially for certain types of companies. So pay attention to this part. Shout out to y'all leaving y'all likes and staying engaged in the chat. I appreciate y'all. Any specific questions, leave a super chat. I'll be sure to get to it for you. So there are specific sectors that are going to benefit. Pay attention here because if you're invested in your retirement accounts, if you're invested directly in brokerage accounts, whatever the case may be, these are sectors that tend to do the best. These are the sectors that tend to do the best. Growth stocks, technology, and other high growth companies can rely on external funding for expansion, the benefit for cheaper capital. So the Fed rate cuts leads to more access to capital for those who might invest in these startup companies and tech companies. Does that make sense so far? Lower interest rates also boost valuations by increasing the present
value of a company's future earnings. Makes sense, right? So we have two different ways that we can benefit. We have two different ways that we can benefit. All right, the next area is going to be small cap stocks. This is a little riskier, but we're going to talk about why. Small companies often carry more debt than larger corporations, so they stand to benefit more from a reduction in borrowing costs. So they'll have more borrowed capital on their books than larger companies will because they're smaller, so they're not generating the revenues the same. So the borrowing costs going down, more capital in the system, and at better rates and terms has a huge positive impacts on small cap companies. Does that make sense? Cyclical sectors, companies in sectors sensitive to economic cycles such as industrials, financials, and consumer discretionary tend to perform well after a rate cut provided the economy avoids a recession. It's an asterisk next to that. But hopefully that makes sense for you. So banks, other in the financial sector, industrial companies are those that are closely tied to industrials. Consumer discretionaries. So think about a Costco, for instance, a Sam's, things of that nature. Consumer spending is another area that is benefiting from Fed rate cuts. As borrowing costs on loans fall, consumers and businesses have more money to spend on non-essentials. What does that look like? Consumer discretionary, companies in this sector, which includes non-essential goods and services like travel, apparel, and even entertainment, may see a boost in sales. So, for instance, I am in the New Orleans market, generally speaking. We are a very tourist-dependent economy. So the companies that are tied to that and even our overall economic base, consumer discretionary is important in our economic market. For instance, so the Fed's cutting rates will be something that we may see an impact on in the broader economy in my market, where I am. Where you are could be very industrial. It could be, financial hub. It could be a tech hub. You name it. But this is just a given example. Auto and credit. Lower rates on credit cards and auto loans frees up disposable income, driving up demand for new cars and consumer goods. So that's another area if you're anywhere tied to that. Bonds and fixed income. The inverse relationship between interest rates and bond prices creates a specific opportunity for fixed income investors. Rising bond prices. When the Fed cuts rates, existing bonds with higher fixed coupon payments become more valuable, driving their market price up. This can create opportunities for capital appreciation, especially in longer term bonds, which are more sensitive to rate changes. Actively managed funds, yield seeking. So investors might consider actively managed bond funds to navigate changes in interest rates and maximize returns. Yield seeking. As the yield on newly issued bonds and cash equivalents decline, income-oriented investors may shift to higher yield investments like dividend stocks and longer-term corporate bonds. That makes sense. Alternative investments. This is a big area. Gold, international equities. So that's going to be important. This is where we need to get down to the weeds so we can get past all the technical jargon. We got almost 30 plus minutes of the technical stuff. Hopefully for those of you that have come in and joined, have gotten a good gist, who the Fed is, what they do, why they do it, what they're doing now with the rate cutting cycle, economic stimulus, how it impacts the wealth gap if you're on one end of the spectrum or the other, and where the opportunities are going to be generally speaking. Let's get into some raw conversation really quickly before we end this live for the night. So what's important to understand is the black and white of rate cuts is not going to be there the same this go around. Okay, what I mean by that? It's not going to be a scenario where lending is just going to loosen up, money's just going to free flow, everybody's going to end up with a bunch of money in their pocket, and it's just going to be like roses and rainbows and sunshine and unicorns for everybody. The economy is stagnant in a lot of key areas. The job market is changing, real estate is changing, banks are still leery, government policy is still up in the air and very contentious. So there's some uncertainty still around. And economic development and growth requires a certain level of confidence and certainty. The confidence and certainty part is not very appealing at the moment. But the economic levers of more money in the system and the borrowing costs coming down, the tax benefits and the tax changes are creating the monetary and economic factors to make things grow. But the psychology is not great right now. You understand? Is that making sense? So what that basically means is that you have to be very smart. If you are in the workforce, you need to be very, very cognizant of the industry you're in and how it's going to be impacted. If there's a recession, if it's declared a recession, if confidence and certainty doesn't pick up. Also, very important to keep in mind, you need to be paying attention to your investments. If it's retirement accounts, you need to be rebalancing and checking them out. You need to be doing that a couple times a year anyway. But right now is one of those times where there's a systemic shift, changing things that you need to be paying attention. Do not go blind on your retirement accounts and your investments. Just sit it and forget it is appealing. I get it. But if your investments are not performing, then it's for none. So it's very important. Pay attention to your retirement accounts and your investments for the months to come. The next thing is going to be finding opportunities for yourself. Comment, chat down below, and please let me know, those of you who are tied in and tuned in, how many of you are starting a business, operating a business, running entrepreneurship, investing in real estate. How many of you are doing something income-based outside of your job? I want you to get in the chat and let me know. And if you're watching the replay this far in, let me know how many of you are generating income or looking to generate income outside of your job. Let me know down below. This is very important because what's going to end up happening is you need to get your cash. You need to earn more discretionary income in cash so you can get, shout out to y'all coming in, leaving your likes, leaving your emojis, chat down below. Let me know how many of you are drawing income or creating income outside of your job or plan to. The goal, what's important for every single one of us, is to get to a point where our excess cash and income can go into assets. Because what's going to happen, Mr. Mentor Credit Jams, I've been seeing you coming in on the comments, leaving your support. I appreciate you coming in the building. Thank you. I don't know how long you've been in, but we diving deeper on the Federal Reserve's rate cuts and that cycle that went in. So if you just happen to be just coming in, that's what we're covering. Got into the weeds about who the Fed is, what they do, why they're doing it, why rates are getting cuts, the drawbacks of it, the impacts on the wealth gap, and now the opportunity for us to make moves. And that's coming down to getting cash in our pocket. If you have access to capital, you can get access to capital. Your banking relationships are going to be important. Your lending relationships are going to be essential. Getting access to capital and increasing your income at the same time to get into assets before the impacts of the economic cycle we're in and the rate cuts kicking in, get to the asset prices. Did you catch that? Did you catch that? Getting your income up and getting your access to capital together to deploy those into assets fast enough, soon enough, before the economic cycle we're in gets to the price of those assets. The stock market is going to react relatively quickly. Within weeks to months of these rates getting cut, we will see changes in the stock market. It's already been going up damn near nonstop, other than the presidential situation and the election, and the incoming administration the first 4 or 5 or 6 months with the tariffs and all of that stuff. Other than that, the stock market has been going bonkers, even with quantitative tightening and the rates being up. Now the rates are getting cut. The environment that stimulates the stock market is coming. It's here. So you need to get your money in position either through your retirement accounts, increase your contributions. Investing on your own, increase your cash flow and put more money in. Real estate is going to be slower. The opportunity will be there in real estate for sure. And we need to talk about that part. So much money is going to get injected in the system. Where is it going to go? One of the areas it's going to pour into is opportunities in real estate. There's going to be a lot of programs popping up for first-time home buyers and home buyers. A lot of different grant programs. There's going to be a lot of state, city, and private bank funding towards home ownership. The real estate market is stalled in a lot of the country. And in some parts of the country, prices are even dropping. What that means is that, and we have a president that is very real estate censored. So, all signs are pointing to some of the biggest tax benefits are around real estate. Now we're going to have more credit in the system, lower rates, better access to capital, ideally speaking. And this should lead to wage increasing. These rate cuts, if they have the impact that they're intended to have, should lead to those of us that are working jobs still to start seeing pay wage increases. Like Tom was mentioning earlier in the chat, competition for your labor. So you need to use that to your advantage. Discretionary spending. Those of you who are in the gig economy, if you're doing gig work, people will have money for Uber Eats and DoorDash now. People will have money for if you got an Airbnb or if you do cleaning services for Airbnb. Either end of the spectrum. This is how you need to start looking at Fed rate cuts. This is how you need to start understanding interest rate differences and economic cycles. Where will the opportunity be? Stocks are overpriced and will go up in the short term, but will probably come back down. They might. The stock market seems extremely disconnected from reality. I don't know how many of y'all been paying attention. That's a great comment. That's a great perspective in the chat. It might. In theory, we would believe they're overpriced. The price to earning ratios are out of whack in a lot of cases. The stock market has been pumping higher even with with quantitative tightening and higher rates. That's supposed to be negative. But the stock market closed at a high in 2024. And other than Trump coming in with a lot of the things he did, the market went up. It's back up this year. I'm still dollar cost averaging though. Exactly. The end of the day, real wealth is poured in the stock market. Yes, real estate is essential. But real estate for the wealthy is a place to shelter money. It's a tax advantage thing. It's a stability thing. It's a diversification thing. They make a lot of their real returns in the stock market. I don't know how many of y'all caught EYL, dropped a video not long ago. I really plan on doing a whole video around this. But they talked about how the stock market is a better place to build wealth than real estate, than home ownership specifically. Not as much real estate investing, but home ownership. They have a point, especially in the home ownership. Now, I'm still a proponent of home ownership. Don't get it twisted. But you will make faster money and larger gobs of money, gumps and gobs of money in the stock market, generally speaking. So dollar cost averaging is one way to go about it. If you have retirement accounts at your job, focus on them, rebalance them, make sure they're in a good position, and contribute to them at a healthy rate. So we need to be finding out how to get more income and access smart capital to get into these assets before the prices get out of our reach. That is the name of the game. Don't get cut down. Make sure that your industry is going to be at a benefit and be attentive to the economic cycle. Exactly. Get in now. Exactly. Get in now. When it comes to the stock market and all assets, gold, crypto, those of you who are into crypto, I am not a crypto person, but I respect it as a viable place that's becoming an asset class at the end of the day. I'm more bullish on the technology behind it, the blockchain and stuff like that. But listen, at the end of the day, it is what it is. This is a place. If you're already in the crypto market, that's a place. Gold and silver, I'm a huge proponent of precious metals. I think it's smart strategy, especially in a rate cut environment. Gold and silver have been doing well this year if y'all haven't been paying attention. Because governments are spending out of control. Inflation is still not at a completely healthy point, right? And now we're going into an environment where the rates will be cut more intentionally. There's a lot of factors that affect gold and silver, but I can tell you it's a smart place to park your money as more of an insurance for your wealth, a hedge. And honestly, the silver part of it potentially could be a great investment in the years to come. Seriously speaking, real estate as a homeowner, real estate as an investor. The goal at the end of the day, and I'm telling y'all now, the money is going to pour into these grant programs for home ownership. It's going to pour into opportunity zones for real estate if you're an investor. It's going to pour into grants for the wealth gap. You're gonna see that decorated a lot. They need to put this money somewhere, people. They need to put this money somewhere. I'm telling you places it's gonna go. I am a banker by trade. I work with CDFIs. I work for a big private bank. I work for CDFIs, community development financial institutions. I work around credit unions. I work around these things closely. I watch the money get injected in the backfield. They're not gonna put it directly in your hands like COVID because you're not locked down. So you're able to get out, earn, and spend. But they're gonna put it in other places they want you to function. They want real estate to get more activity. They're gonna put money behind it. Watch what I tell you. They want more activity in certain areas of business. Wealth gap is gonna be a huge one. Closing the wealth gap. So you're gonna see a lot more money if you're black and brown. If you're in certain communities that have been marginalized, there will be money for grants on business ownership, home ownership. They're gonna find ways to inject money in various places to get people off the sidelines and get them engaged in the economy. Your goal is to get your hands on this money through increasing your income, increasing your earnings, and in getting smart access to good, affordable capital. That is the name of the game. Once you do that, jump on smart assets, smart stock market investing, real estate investing, gold and silver, smart crypto. Like, find the avenues that make sense for you. Don't try to get into everything. Find the areas that make sense for you, that you're comfortable with and that you have enough knowledge based on. Get your hands on the money that they're gonna pour into the system. Find out where it is by watching this channel and doing your research. And I assure you, you get in on these assets before the prices get through the roof. That's the name of the game. That's how you create your first generational wealth. That's true pioneer activity. That's how you pave the way for generational wealth. Get access to this cheap capital. Get it through wage growth. Get it through extra income. And then turn around and get it through cheap, affordable, smart capital. This channel teaches you these different things, especially how to get it through the banking system and the lending system. I'm teaching you that stuff because you need to get into real estate, get into crypto, get into stocks, get into it now. It's close to now as possible. Yesterday was the best day. Today is the next best day. Get in now. Get in now. Just said it. My person in the chat just laid it out there. Get in on these things now. Economic stimulus is basically going to be money poured into the system. Wealthy people are already on top of this. They're well connected. They got the systems. They got the infrastructure. So the Fed rate cut is only going to make them wealthier. What are they going to do? Turn around and access more capital, buy more resources, buy more assets, buy and expand their businesses, buy more real estate. They're going to do it fast. They're going to do it fast. Those of you who are upset because all these big companies are buying houses in neighborhoods and buying up whole neighborhoods, it's going to get worse. They're going to do it at scale. You as the individual and as small as households, as couples, communities, if you're in church, your church, whoever, you need to be getting your hands on this capital and getting your piece of the pie while it's available. This won't last forever. It just got stated in the chat. It won't last forever. The cycle will change again. They will tighten up again. Inflation will get out of control. They'll have to tighten up. Spending might get out of control. They'll have to tighten up. And it's a game of musical chairs. Those who have the assets will benefit and lock in. Those who don't gonna get left out. So comment down below. Let me know what y'all think about this, what concerns you have, what opportunities you see. The chat was very active. I appreciate every single one of y'all that stuck it out. Those catching the replay, shout out to every single one of y'all with the attention span to get quality information to advance your finances and to customize your blueprint for prosperity. Get in the chat down below. Let me know what y'all think. Any final thoughts before we wrap up, because I'm about to close this out in a second. If you're watching the replay, comment down below. I'm very responsive. You got any questions, leave me a super chat either on the replay or now in the chat. Other than that, I want y'all to know y'all can time. Once this gets uploaded, there'll be links added on eventually. You can time with me on Instagram. There'll be a link for that. If you want to work with me one-to-one, either comment down below. I can help you with your business banking, your consumer banking. I can help you around accessing capital, buying your first home, buying investment properties as the lender side, the banking side, accessing credit cards and positioning yourself. Thank you. I appreciate you. Sherelle, am I saying that right? If it is, if I'm butchering it, I apologize, but I appreciate you. You were very engaging and left some great comments in the chat. If y'all want to work with me one-to-one, I specialize in a multitude of different arenas that can help you really get the hand-holding you need to expand your wealth, maximize your banking relationship, better relationships and access to credit cards, home lending, life insurance, stock market investing, etc. If you're looking for somebody that you can tie in with and not just get the general videos, but get in the weeds of your specific situation, this is an opportunity to do so. Other than that, to all my pioneers, welcome back. To my new viewers, welcome in. I want each and every one of you to stay focused, stay in motion. I'll see y'all soon. I don't think about the stock market in the short term, except for buying opportunities. April 7th is an example of buying opportunities. I poured money in while they were selling, and now I'm at a new high. I had to read that one before I got out. You know that was my exit, but my guy Tom has been leaving some great chats, and this is another one. Knowing that to be a long-term contrarian, Tom, that's what it is. Long-term contrarian. Knowing that at the end of the day, as long as this system is functioning, that the stock market has no choice but to ultimately go up. So that's how you do it right there. Long-term contrarian. When everybody's running, when those are fearful, you be greedy. When others are greedy, you be fearful. Shout out to Warren Buffett. Shout out to you, Tom. Shout out to my pioneers. Stay focused. Stay in motion. I'll see y'all soon. Appreciate you, Scott. I'm looking forward to seeing you again soon. Great.